Director and CEO at company, now joins us. Mr. Narang, morning. Thank you so much for joining us here on ET Now. You've reported strong revenue growth on a year-on-year basis, but sequentially there has been a dip. If you can tell us, is it only because of monsoon, or is there any other factor which weighed heavy on earnings?
So actually, thank you for being here with you. Principally, we had a marginal dip in Q2 on revenue versus the last quarter. Keeping in mind, last year we've grown by almost 50%. So this is just a monsoon-led extended monsoon reaction, and we will make this up in quarter three. So actually, there is no problem at all. Severe monsoons and some ROW delayed some execution.
All right, Mr. Narang, hi, morning. This is Shrishti also joining in, but just wanted to touch on the margins. Is the margin hit only because of the higher subcontracting expenses, which are up over almost 200% YOY? What are the margin levels that you are targeting for the remaining fiscal?
So, ma'am, we had given a guidance of 11.5 to 12% in the beginning of the first quarter. And if you see our numbers, we are very much there, 11.93. So there is no margin dip, but keeping in mind last second quarter of last year, we are down by approximately a percentage point, principally because we had some high margin jobs which finished last year. And this year we had to crash a few jobs which were legacy. So we are pretty much in the zone. We maintain our guidance of 11.5 to 12% for this year.
Okay, and inventory meanwhile has risen substantially for the first half of the year. I was going through your inventory position, which now stands at about 798 crores, which is an uptick of a solid 48% in the first half. If you can tell us what led to this, and is it expected to normalize going forward, or is this the new normal now?
No, it's not the new normal. Basically, the inventory has two facets. One is finished goods, and one is the stock you keep for making new products. So the delay in dispatches happened because of heavy monsoons, and Baroda, our plant, was flooded. And some inventory norms have changed for our conductor plant, which will be slightly higher, but we will be making sure that at least 30% of this is actually billed in this month of November and December.
All right, but along with that, with the unexecuted order book, including the L1 at 17,799 crores, what is the expected run rate of the execution over the next 12 to 18 months?
Ma'am, we had forecasted 25% growth. And the run rate, if you see, we are in the zone of growing by 25% every year. This order book will be 2.5 years, what we have, book to bill. And you will see that we are actually executing faster than what we did before. And that's why the huge bump up in the execution and revenue. So this is good for us, 2.5 years book to bill. And of course, we are going to garner more orders in the next 5 months. So the T&D story is good. As you know, we are backward integrated. We have our own towers and conductors and testing and poles manufacturing. So we are fully backed up by our own support system. And what I have just mentioned, these products are almost 60 to 65% of the EPC need. So we are ramping up for execution. And therefore, we are in a good zone to meet the customer requirements.
All right, and when we look at the numbers, I believe last time you did tell us that you're looking to achieve 25% revenue growth for the full year. Now, for the first 2 quarters, and considering that you have reported a decline in the second quarter, will you be able to make up for it in the second half of the year to be able to achieve that 25% growth rate on the top line?
Yes, very much. If you see versus last year, we grew by 61% in H1. And for the balance H2, our industry predominantly post monsoons does better. So we're very much comfortable in the zone of 25% plus growth.
All right, Mr. Narang, with this we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you for having me over. Our pleasure.